Thanks for staying with us here on The Morning Run. You're with Lin Mark, Julian Ng and Wong Shaning. It is 7:35 in the morning, Tuesday the 6th of August. In some international headlines for you, the Chinese yuan has tumbled below 7 per dollar for the first time since 2008. This was amid speculation that Beijing was allowing the currency to depreciate as a means to counter President Trump's latest tariff threat.
So the exchange rate fell by about 1% to $7.0256 at about 10:20 a.m. yesterday. It happened after the People's Bank of China set its daily reference rate at a level weaker than 6.9.
And this was the first time since December that this happened. So for more on this, we have on the line with us a former BFM presenter himself, Tan Chung Han, who's now market analyst at FXTM. Nice to speak to you again, Han. So what were the key factors that led to the yuan plunging below 7 per dollar for the first time since 2008?
Hey, thanks for having me back on again, guys. Look, so the key factor for the performance yesterday for the onshore yuan, and like you guys pointed out earlier, it's because you have the PBOC that's setting its daily reference rate past that 6.9 level for the first time since 2008. Now, what that means is, given the timing of all this, you've got the Chinese central bank that's willing to tolerate that weaker yuan against the US dollar. Now, note that this comes days just after US President Donald Trump threatened those new tariffs, all right, come September 1st. So for us, we'll be closely monitoring the PBOC's daily reference rate in the days and weeks ahead. Of course, the next one coming out in less than 2 hours from now, just shortly after 9 a.m. today, because we want to see, right, how much more yuan weakness will be tolerated by the central bank.
So the PBOC also said that they wouldn't weaponize the yuan, and at the same time, the US has labeled China a currency manipulator. What are the implications of this? This sounds really serious.
Right. Well, to be clear, there are no direct implications here per se, as in it doesn't impose immediate financial penalties, but it sends a very strong risk-off signal to the market. So hence the sell-off we have seen in risk assets yesterday, and we expect that sell-off to continue today as well. Because, look, this means that FX now has a more pronounced role in U.S.-China tensions, and it's official as well. And it's no longer just confined to trade, right? I mean, granted that scope for tensions, that scope has been widening, in recent months, with elements of tech dominance making its way into negotiations earlier this year. So now with currencies officially being thrown into the mix as well, look, it really makes it that much harder for the U.S. and China to reach a compromise.
And Han, what's the impact of this currency war on the ringgit?
Right. So I think, again, the key thing here is that risk-off signal that it's sending to risk assets, and that includes Asian and EM currencies as well. So if this deteriorates further, we could see the ringgit potentially opening a path towards that 420 resistance line that we saw just a few months ago. Again, that's if it breaches that 418 mark, which is just a few pips away now. And look, if we see global trade conditions deteriorate further, given this battle of the wills between the U.S. and China, that's going to weigh on the economic outlook as well for open and trade-dependent economies here in Asia. I mean, keep in mind, Malaysia's, if you take trade as a percentage of GDP for Malaysia, according to World Bank data from last year, it accounted for about 130% of GDP or so, right? So if these stronger external headwinds then perhaps incur more monetary policy easing, that could lead to some softness in the currency as well.
And thank you so much, Han. That was Tan Chung Han, market analyst at FXTM. His expectation is if that the situation continues to worsen, we may see the ringgit hit a 420. That is, if it manages to breach that 418 resistance level.